Hello, good evening everyone and welcome to Bursa Malaysia's webinar. My name is Edna and I am the moderator for tonight. Before we begin, I want to do an audio check. So if you can hear me, can you please click the raise hand button? If you can hear me, can you please click the raise hand button? Okay, I see a lot of hands. Still a couple more to go. If you can hear me, please raise your hand button. Okay, great. Everyone can put down your hands now. Now, as usual, our webinar consists of two segments, 90 minutes long. The first 60 minutes will be by our speaker of the day, and then we'll proceed to a 30-minute of Q&A session. Before we begin, there will be disclaimer. Whatever we share in this webinar will be for educational purposes only, and in no way do we recommend any buy or sell signal. So if you want to buy or sell any stock, it will be based on your own judgment and risk. Is that all right? Okay. Now, this is our webinar series for this year, and today we are at session number 7. We'll be talking about warrants. So today we'll be sharing with you about some basic about warrants, the characteristics, what are the differences between company and structured warrants, what are the risks and rewards of warrants, and some strategies to trade warrants. And in our next session, which is on 7th of August, we will be talking about oscillator. Later on, we will share the registration link with you. Okay, now before we begin, I want to introduce our speaker for today, Alex. Alex is a financial professional with background in stockbroking, equipment and project financing, commercial credit, loan documentation, and credit administration. He has been a capital market service representative since 1994 and is currently a remisier attached with Kenanga Investment Bank Berhad. And Alex has a lot of experience in the capital market, and he has contributed his experience as on his personal blog, Next Trade, which you can visit after the session. He is also an official blogger for investment portal for malaysiastockbiz.com. And he's a presenter for Capital Today on Capital TV. And he's also a social issue columnist for the Merdeka Review, which is a Chinese portal in 2011. Alex also conducts a lot of investment education programs for Bursa Station, Share Investor, and also webinars on kclau.com. So without further ado, let me pass you the control, Alex. Okay. Please take it along. Okay, you have control now, Alex.
Thank you, Agna.
All right.
Good evening. I'm Alex Liu. As explained, I'm a remisier with Kenanga Investment Bank, and I'm also a blogger. I have my personal blog known as Next Trade. I started this blog to share my thoughts on the market and also investment and trading ideas that you can use in the market. Now, when I first started blogging in 2006, one of the interesting events that happened that year was the introduction of a new class of warrants in the market. And these warrants were relatively cheaper, but they also have shorter tenor or time to expiries. But more importantly, they were a type of warrant that you can't find in the market because they are warrants over blue chip stocks. So you have like Maybank, Telecom, and the Naga warrants issue in the market. Now, I followed that development for a few weeks, and I posted my first article on these core warrants in October that year. I still remember there were about 24 core warrants issued then. And when I prepared for this webinar, I did some checking, and to my surprise, we now have something like 670 structure warrants. Structure warrant, of course, consists of both either call warrants or put warrants. And if you add that to the warrants of existing stocks in the market, which is around 270 or so, you have something like 900 warrants of various classes in the market. And that is simply amazing because, as you know, on Bursa Malaysia, you have slightly over 1,000 stocks listed, and we almost have 1,000 warrants in our market. So it is a good opportunity for me to share my thoughts on these warrants. And I think that most people, when they think about warrants, they think that it's a very popular instrument for trader because it is relatively cheap. You have big volume and you have volatility. In another word, you have this amazing ability to actually have a sharp rise in the market. And I think that really attract a lot of retail players. But there is something that I noticed that most retail players do not have a very good grasp on warrants and what are the features of warrant and how to trade warrants. So this evening, I would like to share with you 5 topics. Firstly, an introduction on warrants. And what are the terms that you look for in a warrants and how do you evaluate that warrants? What are the main characteristics of warrants that make warrants so attractive? And then, more importantly, how we can trade warrants and what are the risks that you may face when you trade warrants? So these 5 topics will be what I will cover today. Now, most people would know that warrant is an option. It's a financial instrument that actually gives you the options to buy or sell the underlying assets. Now, options is something that confer you the rights to buy or sell. There's no obligation at all. If you choose not to buy or sell, that's fine. So it is an option to buy or sell underlying assets at a predetermined price, which is known as the exercise price or the strike price, on or before a future date, known as the expiry date. Now, the easiest way to categorize warrants would be to look at what is the rights being conferred. So when you talk about a call warrant, the rights being conferred is the rights to call or to buy the underlying assets. And put warrant would confer on you or give you the rights to put or to sell the underlying assets. Right. Now, another way of categorizing warrants would be to look at who issued the warrants. So broadly speaking, warrants on Bursa Malaysia can be divided into either company issue warrants, or you simply refer to them as warrants, or structure warrants. Now, structure warrants itself is divided into 2 categories. You have the core structure warrants, and then you also have the put structure warrants. Now, in the market, we simply call them call warrants or put warrants. Now, let's look at the differences between these 2 broad category of warrants, right? Now, we have here the core company issue warrants, and then here would be the structure warrants. Now, company issue warrants issued by the companies, and the underlying assets will be obviously the share of the company, and the tenure or maturity period is long-term. Normally is 5 years, but it can be as short as 2 to as long as 10 years. And the purpose of issuing these warrants is for the company to raise funds, and also for the shareholders who are the first to receive it. It is an opportunity to participate in capital appreciation of the share of the company. And they're mostly call warrants, meaning say that it gives you the rights to subscribe for shares. So no company is going to issue put warrants. Okay, that was just simply say that I expect my share price to go down. So that won't happen. And The mode of settlement is physical settlement, meaning to say that on or before the expiry date, you exercise your rights to convert your warrant to shares, and then you will receive the share in your account. So that's physical. And the style of exercise is normally known as the American style. You can exercise anytime up to the expiry dates. And you can find them mixed together with the underlying assets, either in the main board or in the ACE market. And you can tell them by the suffix at the back. It will start with a W. So in this case, you can see here ABCWA. That would be the first warrant issued by this company. Now, the other type would be the structure warrants, and they're issued by investment banks. Currently, there are 6 licensed investment banks that can issue structure warrants in Malaysia. Kenanga Investment Bank is one of them. And the underlying assets would be individual shares, baskets of shares, indices, commodities, and currencies. In the early days, you can find commodities. I haven't seen any currency call warrant or put warrant, but these days it is more on shares and indices. And the tenure of this warrant is normally around 6 to 9 months. So they are neither too short or too long. And the purpose of issuing this structure warrant for the investment bank would be for fee income, and for traders or investors, the purpose of buying or owning structure warrant would be either for trading or for hedging purposes. For this evening, we will talk strictly about trading. And they can be both types. You can have call warrants or you can have put warrants. But since the early days, this has dwindled down to mostly call warrants on over shares, domestic shares, and put, and also call warrants on the indices. And the settlement is normally cash settlement, that is different from physical settlements, in the sense that you do not have to exercise, you just let it mature, and then the issuer would compute how much is owed to you, and then they will credit your account. Now, normally the style of settlement is what you call European style. They would do the settlement one go at the expiry date. So everybody's warrant will be then compiled together, and then they will credit you if the share price or the asset value is higher than the exercise price. And structure warrants is found in the structure warrants board, or if you want to look for them, you go to Bursa Malaysia, you go to structure warrants as the sections, and they're all listed there. And how you can tell them apart from warrant, the normal warrant, is that the suffix at the back for call warrant will start with a C, and for the put warrant will start with a H. So we have got that out of the way, how to tell the difference between company issue warrants and structure warrants. So now let's look at what are the main terms that you need to look for when you want to evaluate a warrant. Now, the terms are mostly, you can find them on the term sheet when the warrant is under the initial offer process. Later, you can also find them under the listing info or profile. Mainly, these are the terms. Okay, you need to know the underlying assets. It may be a stock, say Tenaga, and you need to know that it is a call warrant. Okay, you can't find put warrant and Tenaga, but it's call warrant. And the next 3 items, these are probably the most important terms to determine the valuation. It would be the exercise price, the expiry date, and the conversion ratio. The conversion ratio simply refers to the number of warrants that you have to own to be entitled to so-called convert to one shares of the underlying assets. So if it is 3-to-1, that means you need 3 warrants, then you can exercise and convert to 1 shares. And the last 2 items will be exercise style and mode of settlement. These 2 are not that important, but some people would like to know about them because they want to know whether, do I have any advantage in having, for example, American style. In my opinion, they're actually probably not so important. So these are the main terms in evaluating a warrant. Now, I already mentioned just now that these terms we found in the listing profile. Now, if the stock were to undergo a corporate exercise, like say a bonus issue, the exercise price of the warrant as well as the conversion ratio would be revised accordingly. So if you go back to the website, Bursa Malaysia, you'll find that the new exercise price as well as the new or revised conversion ratio will be stated therein. All right, next, I would like to share with you about how you can value warrants. Now that's important because you want to know what really impact the overall value of a warrant, right? I'll take a sip of water here. Now, warrant value consists of 2 components. First part is the intrinsic value, and the second component is the conversion premium. Now, let's take one example. ABC stock, and it's trading at 2 ringgit. ABC has 1 warrant, it's warrant A, and the exercise price is 1 ringgit 50 cent. The expiry date is in January 1st, 2020. So in terms of time to maturity, it is well over 1 year. So it's something that we can put aside for now. And immediately, even if you were to talk to a beginner in the market, he will know that this warrant has some value. And that value is simply the share price minus the exercise price. Oh, by the way, let me go back. This ABC warrant is a company issue warrant, and all company issue warrant has a conversion ratio of 1-to-1. Okay, yeah. Back to the value of the warrant. The value of the warrant, at the very least, would be the share price minus the exercise price. It would be 50 cents. Now, we call that the intrinsic value, right? Now, assuming that ABC has 2 other warrants, right? Warrant B and warrant C. Now, warrant B has an exercise price of 2 ringgit, and warrant C has an exercise price of 2 ringgit 50 cent. Now, if you look at that, and assuming the share price is still at 2 ringgit, you would be able to tell that, okay, the intrinsic value of warrant B is 0, yeah, which is actually arrived at by taking share price 2 ringgit minus the exercise price 2 ringgit. So interest value is 0. The intrinsic value of warrant C is also 0. Now, if you do the computation, it will be 2 ringgit minus 250, and you will say, well, it's negative 50 cent. Now, intrinsic value is always positive. It is either 0 or it's positive. In this case, it is 0. It is not minus 50 cent. So if all these 3 warrants are traded at the market, and you have the market price here, 65 cents for warrant A, and 12 cents for warrant B, and 5 cents for warrant C, you would immediately be able to compute what is the conversion premium of these warrants, right? So you take this one, 65 minus 50 cents, 15 cents would be the conversion premium, and so on. The next thing I want to share with you is about the status of this warrant. Now, warrant A is considered an in-the-money warrant. ITM is in-the-money warrant, meaning to say that this warrant has an exercise price that is lower than the current share price. So there is value to this warrant, and that is called an in-the-value warrant. And warrant B is having an exercise price same as the share price. So it is known as an at-the-money warrant. It's right at the money. Whereas warrant C is out of the money. It is the exercise price is higher than the share price. Now, looking at this at one glance, most people will want to own warrant A. They probably won't mind owning warrant B, and they probably would avoid warrant C. Let's see what would happen if the share price were to go up by 20 cents. Right? So if it go up by 20 cents, you can see that warrant B is now in the money. Right? It's in the money by 20 cents. And assuming the conversion premium is still 12 cents, you would have a value of 32 cents. Whereas warrant C is still out of the money and it only has conversion premium. There's no intrinsic value, so it still remains at 7 cents. So from this very simple exercise, before we go in depth, you will find that people prefer to own either in the money warrant or at the money warrant. The difference, of course, you pay more for the in the money warrant than at the money warrant, because at the money warrant, once you actually become in the money, there will be a jump in the price. So basically, this is how you determine the status of a warrant, whether they're in the money, at the money, or on the money. Right. Now, I'd like to talk a bit about conversion premium, because this is a little bit more subjective and not so straightforward as intrinsic value, because intrinsic value is simply you take two prices, share price and exercise price, and you minus one from the other, and you have intrinsic value. That is very straightforward. Conversion premium, on the other hand, is not so straightforward and determined by 4 factors. Number 1 is time to expiry. Yeah. So if the time to expiry is very short, right, conversion premium will be smaller. Okay, I'll talk more about that later. Next is interest rates. Now, if interest rate were to go up, the impact on warrant is positive. Yeah. Why? Because warrant is viewed as sort of buying share on the margin. So if you buy share on the margin, meaning you put a small amount of outlay to expose yourself to stock, that means that you save up some money instead of buying the entire shares. I mean, buying the shares the way you spend more money. So when the interest rate goes up, right, the so-called saving on that amount that you do not have to expand to get exposure would obviously goes up. So that's why when you have interest rate going up, the price of warrant would go up. Next, you have dividend forecast. Now, warrant is not shares in the sense that you are not entitled to dividend. And because of that, when the warrant of a stock, the dividend of a stock goes up, the forecast of it going up would actually enhance the value of the share and would be at the expense of the warrant. So dividend forecast going up, warrant price will come down. And lastly, expected volatility. Expected volatility is a fairly subjective thing. It is your expectation of the distribution of future prices for that particular stocks. If you believe that the price may spike up and there are more people in the market sharing the same belief, then you probably would like to be owning that warrant and together with others, and that would then lead to the warrant having a higher price. So expected volatility, the higher it is, the better it is for the conversion premium of a warrant. So we have now covered what is warrants and what are the terms that determine or affect the value of a warrant. So we also have looked at the two component values of warrant, that is intrinsic value and also conversion premium. Now I would like to come to the two main characteristics that make warrants so attractive, and they are basically gearing and limited risk. All right, I'm going to do this with by looking at two examples. Now I begin with gearing. Now gearing simply means that if you want to be exposed to a particular stock, warrant allows you to do that with a smaller outlay. Okay, small outlay. And because of the smaller outlay, when the share moves in the directions of the warrant that you have positioned in, say you bought the call warrant, you're expecting the warrant to go up, you're expecting the share price to go up, and it actually went up, the return, the percentage return for warrant is generally higher than share. Right? I'm going to share with you about Hata, which is a rubber glove company. You have here 42 quarters of revenue and profits. Right? We can see that revenue is rising, and similarly, the profit of the company also rose, but it was only in 2017, because before that it was pretty flat until March 2017, and when the result came up, pre-tax, for example, jumped way above the normal, which was around 80 to 90 million. It went up to about 120 million. So this is a breakout in earnings, and it's also reflected in the share price of Hata. If you look at 2017, in the month of June, the March result came out in June, there was also a breakout in the price. The share price went above 3 ringgit. Now, if you observe this, you have earning breakout, you have price breakout, then you want to get into the stock. Now, in November, a new call warrant was issued. It is Hata C2, and that gives you an options. Should I go into the share or should I get into the call warrant instead? All right. Now, these are the statistics. In November 2017, Hata was trading at 4 ringgit. C2 was trading at 20 cents. Now, if you just go up to April 2018, by the way, this warrant has expired just about 2 weeks ago. It has a conversion ratio of 3:1, and the exercise price is $3.72.5. All right. So in April 2018, you can call that a peak. Hata reached a price of $6.50, and C2 hit a price of 95 cents. You can see that in terms of return, the return on investing in shares at 63% is very respectable, pale in comparison to that of C2, which is 375%. So that is why people like to buy warrant because of the gearing effect. Right? Of course, there is a double-edged sword. If the share price did not go as you anticipated, the gearing effect would mean that your percentage lost would be higher than that of the share, right? So picking the right warrant is just as important, if not more important. So let's look at the second one, which is warrant limited risk, and I'm going to use an example of MRCB warrant A. Now, here you have MRCB revenue and profits for the last 20 years, 20 quarters, 5 years. As you can see, in terms of profits, it is actually nothing to shout about. It is basically hovering around the below 50 million a quarter. Yeah, sometimes even as low as maybe 10 million. So there's nothing to shout about. But something happened in 2013 when a new shareholder emerged in the company. His name is Saleh Fateh. He injected his personal company, I believe it's PJ Central, into MRCB to take a 12% stake in MRCB. Now, a lot of people were excited about this because Fateh is apparently a very enterprising businessman, and they were hoping that his entrepreneurial skill would rub off on MRCB. So right after the completion of his acquisition in MRCB, you can see that the share price broke above this downtrend line. Now, assuming that you think that it is a good idea to buy into MRCB, at that point in time, you have a choice between buying the share or buying MRCB warrant. All right. Now, assuming that we're going to make a comparison between MRCB and MRCB warrant, assuming that you bought into them and you hold them all the way until today, and MRCB warrant, by the way, is almost due for expiry. Let's see what happened when you actually get it wrong, all right? Here is MRCB and MRCB warrant. It was $1.40, and when it was issued, it was around 28 cents. The share now is at 66 cents. That means you lost 74 cents. The loss is 53%. And the warrant price is now at half a cent. I round it up to 1 cent. So the loss is 27 cents. That is 96% loss. 96%. So it is a big loss. But assuming that we wanted to buy 10,000 MRCB, right? And if you have chosen to put in to the share, you bought 10,000 MRCB share, your loss would be 7,400 ringgit. But on the other hand, if you decided to expose yourself to this stock via the warrant, and you bought similarly 10,000 warrant, you would have expended 2,008, and even with a massive loss of 96%, your loss would be 2,007. So in that sense, warrant, if you are not overexposing yourself, have a way of limiting your exposure, limiting your risk to a stock, all right? So these are the two reasons why people, if you use it carefully, you can actually enhance your performance. So next, I'm going to share with you the 5 steps in trading warrants. Now, the most important step in trading warrants is actually selecting the stock. Yeah, selecting the stock first is the most important way of trading warrants. For example, the HATA is a very good example. If you have been following Rubber Glove, HATA, or Top Glove, you would have read many reports that were basically bullish on these stocks, dating back up to 2015 or 16. But the fact of the matter is, the earning of these rubber glove companies didn't actually exploded until 2017. So when the earning exploded and the share price jumped up, that's when the warrants would be enjoying exponential rise. So it is very important that you pick the stock that has bullish share price breakout and also very positive earning results or earning growth. If you can do that, that would be guaranteeing your success, right? So select the stock first, and then you do the next 4 steps, right? And all these have to do with the warrants, right? Assuming that you selected Sehata and you look into the available call warrants for Hata, there may be 5 or 10 call warrants. Choose the warrants based on these 4 factors. Number 1, choose the one that has the longer time to expire. Now, we're talking about both call warrants as well as normal warrants. I would put it here that you should try to choose, if it is call warrant or call structure warrant, choose something that's more than 3 months old. And if it is company issue warrants, choose something that is more than 6 months to expire. Why one is more than the other is because normal warrants, normally the exercise is by physical exercise, meaning you have to convert. And most retailers are very reluctant to convert. And when the share come to about 5-6 months to expiry, they will start to sell very aggressively. So anything that is 6 months or less will see pretty rapid drop in price. In fact, I have put down here a graph showing you the time value decay. By the way, conversion premium is also referred to as time value premium. And time value decay simply means that if you issue a warrant and that warrant has time value, that time value can be the decay can be actually divided into 2 halves. The first half of the tenor of the warrant, the loss in time value is about 1/3. The second half of the tenor of this warrant, the loss in time value premium will be 2/3. And the loss is especially damaging in the last 1 month of the warrants. So if you can choose a call warrant that is more than 3 months to expiry, that is the first thing that you do, you choose the warrant. The second thing in choosing the warrant would be don't pay excessive premium. Okay, so in the case of call warrant, call structure warrant, don't pay anything more than 10%. So for normal warrant, don't pay anything that's more than 20%. So how do you compute the warrant of stock? So the warrant of stock is, okay, you take warrant price time conversion ratio, okay, the product of this, you add to exercise price, right? Then the total of that you divide by share price. I'll give you an example. Okay, the premium for Hata C2. You remember the Hata's C2 warrant price? It was 20 cents at the beginning. It was 20 cents, and the conversion premium was 3 to 1. So each warrant cost 20 cents, and you need 3 of them. So you had to expend 60 cents, and then you add to the exercise price 372 half. So in total is about 32 half, and you divide that by the share price at the initial stage, which was 4 ringgit. So you arrive at 8.1%. So that would be the premium, and that is a very reasonable premium to pay for a warrant. So that's the second thing that you look for. Don't pay excessive premium. Next, you would like to select a warrant that has higher gearing, right? Obviously, because for a smaller outlay, you're having the same exposure. Or for the same outlay, you have a bigger exposure. So find one that has higher gearing. And the formula for computing gearing is share price divided by the product of warrant price time conversion ratio. Again, using Hata C2. We can see here, share price scoring it divided by the product of 20 cents times 3. That is warrant price times the conversion ratio 3. So it is 6.7. 6.7 is a pretty good gearing for any warrants. But when you start to see numbers like 8 or 10, you have to be a bit careful. It's a little bit too high, and it could be because the warrant is due for expiry or the warrant is deeply out of the money. Right? Now, talking about being deeply out of money, that is the other thing that I want to highlight. When you want to choose the warrant, avoid deeply out of the money warrants. Right? Why do you want to do that? It has everything to do with delta. Delta is one of the 4 Greek symbols in option pricing. The others would be beta, gamma, and rho. I'm not going to talk Greek to you this evening, but just on delta. Delta simply means this. If you have a share price, say, going up 10 cents, and the warrant price also go up 10 cents, the delta of that warrant is 1. 10 cents divided by 10 cents is 1. That is a warrant that is very responsive. On the other hand, you may have a warrant that go up only 1 cent when the share price goes up 10 cents. In that case, it is 1 divided by 10 is 0.1. That warrant has a delta of 0.1, which means that that warrant is not responsive. And the not responsive warrants is normally a warrant that is deeply out of the money. So we don't have to really zoom in on delta itself, but we can avoid having a warrant that is non-responsive by avoiding warrant that is deeply out of the money. Right. So as you can see, the number 4, choosing a warrant with higher gearing, and number 5 here, avoiding deeply out of the money warrant. This seems to require a little bit of balancing on your part, because if you have a very cheap warrant, obviously you have high gearing. But if you have a very cheap warrant that is deeply out of the money, it is totally not responsive to a rise in the share price. So you have to bring them together. And normally when you bring them together, these two, when you balance it out, it is normally a warrant that is pretty close to at the money. I mean, you can buy a warrant that's out of the money, but yeah, it should not be too drastically out of the money. All right. Okay, this is quickly summarized. The 5 steps in trading warrant would be select your stocks and then select the best warrants over that stocks. Choose one that has enough time to expiry, not too expensive in terms of premium, good gearing, and also not too deeply out of the money. All right. I'm going to maybe pass the control to Agna for a short while. Agna, I still have one more segment before I conclude. Do you want to take control?
Right, I got the presenter. Thank you, Alex. Now we will launch a poll, and our poll for today is, okay, let me see. Okay, can you hold on for a moment? Okay, let me show my screen. Yeah, can you see my screen?
I can.
Yeah, okay. Our poll is, do you trade warrants regularly? Okay, so I'll give you 15 more seconds to answer. Okay. All right. Now, last 5 seconds. Okay. All right, I'm closing the poll now. Have all of you voted? Okay, let's see. Let's share the poll results. And
Not at all.
yeah, 66% of you are not trading warrants. So you should take the opportunity today to learn all about warrants and get started. So I will pass the control back to you, Alex, to continue
Okay, thank
your
you,
session.
Anna.
Okay.
Yeah, I'm seeing the result of the poll is 66% polled as not trading warrant at all. And
Yeah.
I don't know whether to be shocked or to congratulate you, because the next segment I want to talk about may actually help you to overcome your fear, right? Right. So we're going to talk about things not to do when you want to trade.
Yeah, Alex, you have to share your screen.
Okay. Share. All right.
Okay.
Is that okay?
Yeah,
All right.
I can see your screen.
All right. Now let's move on to the 4 traps in trading warrants. All right. Now the first one would be avoid hot warrants. Now, if you follow the 5 strategy in trading warrants, you would never fall into this one. But it is very easy to fall into this particular trap, because if you're sitting in front of the screen every day and the market is so boring and all that, and suddenly you see something cheap, price shooting up, and you have big volume, I can bet with you that maybe 1 out of 3 you would jump into it, and that is exactly what the player wants you to do, because they give you the volume, they give you a big sharp rise. Remember the thing about volatility. Volatility, in my opinion, is the promise of higher prices. So when you see that, and if the warrant is cheap enough, something like 10 cents or so, people will just jump in, and it's pretty scary. So I always remind people, stick to the 5-step in trading warrant. Now I want to give you an example of how bad it can go. Now, 2 months ago, now it's July. This was in February, so it was about 5 months ago. 5 months ago, there were 2 days in February 22nd and 23rd. We saw this warrant, Toyo Inc. warrant, spike up from 1 cent in over 2 days. It went up to 22 cents, and the volume, which was normally below 1 million, jumped to above 100 million each day. In fact, it is 142 and 119 million. And if you look at the share price, well, it looks like it is probably justifiable for the warrant to go up. The share price actually moved from 64 cents to 1 ringgit and 13 cents. Right. But wait a minute. You look down there in rate. I have put down there the exercise price, $1.50. Despite the big jump, this warrant is still out of the money, right? And the other thing is, the warrant expiry date is on April 23rd. That is 2 months only to expiry. And yet people jump into this warrant. Look at this chart. This is a very, very sharp spike in the warrant price. Some may say that it's justified by the share price movement, but I don't know. I mean, I look at the performance, the financial performance of this company. You look at the 20 quarterly result. the profit of the company is barely above zero. Yeah. So it is not a profitable company. Why did the share price goes up? Actually, if you do a little bit of Googling, you'll find that 2-3 weeks before, there was some announcement about a long dormant project, power plant project in Vietnam, was granted environmental approval to proceed, which is so conveniently used to move the warrant price up. And so many people got caught in this one. Actually, I wrote about it. And that is why if you want to succeed in trading warrant, the first thing you must do is avoid buying hot warrants. All right. The second thing is be careful about overexposing yourself. All right. This one I want to explain a little bit further in the sense that warrant itself, all right, is a geared instrument. One of the characteristics is that it has gearing. Yeah. You buy one warrant, it gives you a gearing of anything like 3 or 4. Even just now we saw in case of Hata, C2, it was 6 or 7 times. So warrant is geared. But if you choose to spend the same amount that you would spend on share on the warrant, then you're doing a second level of gearing up. Let me explain with this example here. All right, back to Hata. All right, now assuming that you want to spend 8,000 ringgit on Hata, so it was 4 ringgit, you would be able to buy 2,000 units, and because it's gone up 2 ringgit 50 cents, your profit would be 5,000 ringgit. Now, assuming that you choose the maxed out approach, when you say you choose to spend 8,000 ringgit on Hata C2, now you spend 8,000 ringgit, you can buy 40,000 units, because 40,000 units times 20 cents is 1,000 ringgit. And voila, you make 30,000 ringgit, right? But assuming that you are one of those steady people who do not want to overexpose yourself, you will say that, I want to buy same exposure, the number of warrant that give me the same exposure to 2,000 shares. What would that be? The answer is you take 2,000 times the conversion ratio 3, it will give you 6,000. If you own 6,000, C2 is about the same as 2,000 shares. And you only have to spend 1,200 ringgit. And at the end of the day, you make 4,500 ringgit, which is pretty good. It's almost as good as spending 8,000 ringgit to make 8,000 ringgit on shares to make 5,000 ringgit. Of course, it is inferior compared to that of the maximum approach. But, maximum approach has its downfall. As I said, it's a double-edged sword. If you use this on approach to evaluate the MRCB warrant A, all right, if you have 14,000 ringgit to expand on the share, you will buy 10,000 ringgit, 10,000 units of shares. And the drop in the share price was 74 cents, you will lose 7,004. Now, if you spend 14,000 ringgit on warrant A, you would own 50,000 warrant A. And the loss is 27 cents per warrant, means that you will lose 13,500 ringgit. If you have been cautious, you will only buy 10,000 warrant, because this is company issue warrants. The conversion is 1:1. So 10,000 warrant will give you the same exposure as 10,000 unit of shares, and you only spend 2,008, and your loss will be 2,007. So you have to be careful about the exposure you take on. Just because the warrant is cheaper, you can be in danger of overexposing yourself. So that's the second trap to avoid. The third trap to avoid is perpetual holding. All right? Yeah, I remember there was one client who wanted to buy put warrant on our index, because he was so sure that Dow Jones is going to crash. And if Dow Jones were to crash, our index would also drop sharply. And if you own put warrant, which is the opposite of call warrant, he would make a lot of money. Now, what he did was he bought the put warrant, and he expected to happen within 1 week. Now, after 1 week, Dow Jones didn't crash, and he says that I better sell it out because I think that it's going to actually go up instead. And it was a good thing because he sold out at a loss of 2 cents. And if I'm not mistaken, that particular put warrant actually in the end expired worthless. He would have lost his entire investment, which was somewhere around 14 cents. So very important that when you buy into call warrants, right? Not necessarily just put one, yeah, you're hoping it go down, but call one, you're hoping that it goes up. That event that you anticipate to happen may not happen, and you should have a cutoff date to exit your trade, right? And of course, the last one, I think all of us are quite familiar, is harboring our losing trade. Yeah, I may not have said it earlier. Warrant is 90% of the time is a trading instrument. It is not like share. You can buy a share, and if you are wrong-footed, you can hold it for 1 or 2 years, and there's a chance they may come back up. Warrant would expire worthless. Okay, so if you got into a warrant and it start to go against you, check again on the share price outlook. If the share price outlook is also negative, we're talking about call warrant, so you're expecting it to go up, but instead it will go down, and the share price is also going down, you better exit. So the best way to do that is to actually, at the early stage, set a protective stop or cut loss price. If you got in at 10 cents, now it may be at 9 cents or 8 cents. If the price drop to that level, you're going to exit that particular call warrant. You should exit it because you want to protect your capital, right? So these are the 4 traps that you should avoid. That is, avoid overexposure, avoid getting the hot warrant, avoid overexposure, avoid perpetual holding of your call warrants, and also avoid harboring losing trades. Okay. So, ladies and gentlemen, now we come to the concluding part. Warrants is an instrument that you may want to consider for your trading, even for your investment, because it can enhance your return. That is through the process we call gearing. And it is not necessarily risky. In fact, in some way, if you do it correctly, it can actually limit your risk exposure. But it's very important to remember that warrants are double-edged sword. So if you have enhanced performance, if you get it right, you would get the opposites, magnify your loss if you get it wrong. So bear in mind, so that's why it's important not to overexpose yourself. So the correct way, the best way to do it is to follow the 5 steps of trading warrants. Yeah, look back later. Begin with picking the right stocks, okay? And then the last thing is avoid the 4 traps. The most important of which is avoid hot warrants. You don't want to get into that, right? So that is our webinar for today, for tonight. Yeah, let me just share with you my blog. This is my blog, Next Trade. You can see this is the first post itself. It was done in July of 2006. And well, I hope that it would help you in your trading when you visit this blog. And of course, I hope that my webinar this evening would help you to decide to try out trading in warrants. Yeah. Thank you so much. I'll pass back to Edna now.
Thank you, Alex, for your session today. And let me share my webcam. Sorry. Let me share my screen. Now we will proceed to the Q&A session. Okay, let me share my screen. Give me a moment. All right, Q&A session. Our first question for today. Nelson Wong is asking that what are the most useful indicators you are using to trade FBM KLCI call or put warrants?
What are the most
Useful indicators you are using to trade FBM KLCI call put warrants?
Nelson, I do not really cover the put or call warrant for indices, or maybe I would answer slightly differently. See how I can get out of this. Anna, if I want to share something, can I?
Okay, sure.
do I share?
I'll give you the presenter mode for a while. Okay. Yeah, you can share your screen already.
All right. Hey.
Okay, we still don't see your screen now.
Okay.
Yeah,
You see my
okay.
screen now?
Yeah.
All right.
Now it's better.
Okay. Let me share with you this very good website. It's called klsescreener.com. It also has a warrant screener, right? If you go to the warrant screener, you can choose what underlying assets that you're looking at or the underlying stocks, and it also include index as well. Okay, Bursa Malaysia, right? So let's say we're talking about core warrants on Bursa Malaysia. So you just click submit here. So you have the whole list here, right? Then you choose what would satisfy the four conditions of what is considered good warrants. Right? For example, if you are buying the call warrant on FBM KLCI, you have to be bullish on FBM KLCI to begin with. Suppose you're bullish and then you choose the warrants. Remember the four factors to look for. Number one is the expiry date. Number two is the premium. Number three is the gearing. And number four is so-called not too deeply out of the money. All right. This would be the thing that you look for. Maybe I choose a stock to go with that. That's easier for you to see because some of you may not be looking at indices. So share may be easier to see. For example, one of the stock that is really going up very gung-ho is Supermax, right? Suppose you are actually keen to look at Supermax. Let's just suppose we are not supposed to call buy on stocks, but let's suppose you yourself is very bullish on Supermax and you want to consider the call warrant of Supermax. All right. So you have this short list here of all the call warrants of Supermax, right? So what you do is you copy this entire list, all right? Okay, and you put it onto Excel sheet, all right? Okay, this is the call warrant of Supermax. So you already satisfied the first condition, which is select the stock first, all right? Then the next one is select the maturity, the stock with the right maturity. All right, so let's say you want to sort out the maturity here. So let's move this to the front, all right? So you would then sort this, sorry. Okay, let me sort it. Okay. All right. So now is July, and if you want it to be at least 3 months or to expiry, that means you want something that is in expiring in October. So anything earlier than that, you can just delete it. All right. So we are narrowed down to these few warrants, and the next thing you want to look at is which of these warrant has high premium, nah? Right? So I don't know why this one doesn't have a number here, right? So this one is expensive. The premium is a bit high, so you would delete this out, all right? And then you are down to, okay, this one is also a bit high. You delete this out as well. So you're down to, why don't we just delete this out? Okay, so this is odd. So you're down to these 5 warrants with relatively a lower premium, and then you choose among them the one with the higher gearing. So this one is below 2, so you delete this one, and you're down to this few, right? So you can choose any one of these, and that would satisfy the condition that we mentioned earlier, the maturity period, the premiums not being too expensive, decent gearing. Well, two over time is not actually very big, but that's the best you have. And in terms of avoiding those that is too deep out of the money, this is not a question at all, because the exercise price is actually lower than the share price now. So yeah, any one of these 4. So that would be the process you go through. Yeah, back to you, Anna.
All right. Okay. The next question is asking about how many percentage of gearing is considered high?
Oh, I see. Well, actually, you want to get as high as possible. But then again, as I said, when you get too high, you have to check out why it's so high. And if it's too high, chances are it is deeply out of the money, or it is about to expire. If you do it the way I just did, you exclude out all the those about to expire less than 3 months, and you also look at the share price and compared to the strike price, you would be able to decide whether the high gearing in this case is acceptable or not. High gearing, the higher it is, the better. But normally, if it's too high, there have to be a catch somewhere. So just rule that out. Yeah, back to you, Anna.
All right. Okay. The next question is how to detect a warrant, the warrant price that will be going up. How do you detect a warrant price that will be going up?
Actually, if you get it right, that is to say that you choose a warrant of a stock that is bullish, eventually, if the share price actually go in the direction that you anticipated, it has to pull up the warrant price. So the thing is, try not to go by way of looking for the warrant and then try to make a case for buying the warrant. More often than not, I'm worried that you may be trapped because the players out there can actually make a warrant so attractive that people actually jump in, and then there are so many things that can justify why something goes up. The Toyo In case, if you have seen the volume, at the share price movement, if you go and do a Google search, you would have justified why you should buy it. The only reason why I wrote something on that, I actually cast doubt on that, is because I know that this company had this project and they sat on it for 10 years, and they just bring out this announcement about environmental approval, and they're actually hoping a lot of people to actually jump into the warrant. Yeah.
All right.
Back to you, Anna.
Okay. All right. The next question is asking, what is the difference between structured warrants and company warrant? If a company warrant can be converted to share, then what is structured warrant used for?
Okay. Let me approach that slightly differently. When I first became a remisier, there was one incident that was quite shocking to me when another remisier shared with me about one of his clients experiencing expiry of a warrant. It is in the money warrant, and the value of that warrant, if you only consider the intrinsic value, was something like 100,000 ringgit. And because this is a very, very big client, and he entrusted the account to this remisier to manage, and the remisier didn't inform him that he has this warrant due, and it actually went expired, and the loss was more than 100,000. So warrants has a different way of settlement. Okay, you have physical, which means that you actually have to exercise. You have to fill out a form, you have to buy the bank draft, and then you get the share. It is really troublesome. Now, some people want it because it is a cheaper way of actually owning the share. You know, maybe you want to own a lot of the shares, so you buy a lot of warrants, and you can actually buy the share in this way. If you wanted to buy the share in the market, you actually move the share up. Now, these people would probably be the major shareholders. But for most of us who are pretty much traders or things like that, we would really like to have something that is cash settled, because you save the hassle of actually worrying about the thing expiring and become worthless. If it is cash settled, when it expired, well, if you're lucky, if the share price is higher than exercise price, the issuer will credit your bank account. If you are not, it is worthless, it's zero, that's it, that's the end of the story. That is basically the difference, and that could be also the reason why some people feel somewhat comfortable trading in call warrants, because they don't really have to worry about the warrant expiring, and they didn't exercise it by subscribing for shares. Yeah, back to you, Anna.
Okay, excellent. And the next question is by Victor. He's asking that for warrants that track overseas index, is there any arbitrage opportunity, especially HKSE, which opened later than FBM KLCI?
I don't think there will be much opportunity because of the premium factor. You know, the premium factor play a part because all these call warrants are so-called cash settle, and their settlement is European style. So basically, you hold it right to the end. But if you are trading, of course, you can buy this week and sell next week. The so-called conversion premium probably wouldn't drop that much. But there is always the conversion premium there. And that part of it, I don't think, since it actually lift up the price, I don't think you actually have opportunity for arbitrage. Yeah, I don't think so. I never tried. Back to you, Anna.
Okay, thank you. And the next question is asking, what is the recommended volume indicator before deciding to trade the selected warrants? For example, do you look at it above 30 million or 100 million in volume?
Okay, actually the danger of using volume to determine whether I should buy the stock or sorry, I should buy the warrant or not is actually it's actually very misleading. I think the better indicator is the buy and sell quote, right? Of course, when the stock is very, very active, there will be a lot of retailer going in, retailer going out, or maybe the players are getting out. So these numbers will be huge, and we're talking about millions and all that. But in the absence of that, who would be in the market would be actually the market maker. So the issuers of most of the core warrants, I think all the core warrants, are the market makers. So at any one time, if there's no trading, they would be there in the market as a buyer and seller. So a good judge of liquidity, so to speak, of this warrant, as in, if I have the warrant, can I get out? How many people, how many number of units are queuing up to buy from me? That's one consideration. And the second consideration is, what is the bid and offer spread? If it is too wide, it seems the market maker is simply not doing his job, because you bought already and now you want to sell, and he's the one buying from you, and he actually want to take it back from you at such a big discount. So this would be a better judge of whether that is a good call warrant to buy. But of course, I think the question came strictly on trading approach. And as I said, the trading approach, you do have to be careful not to fall into the trap of buying hot warrants. Thank you. Back to you, Anna.
All right. The next question is asking, how do we know if the warrants are European or American settled? Is there any pros and cons for each specific settlement type?
Good question. Actually, if you go to the listing profile, listing information and profile, you will find whether it is cash settled or physically settled, and you find that all of them are cash settled, and you'll find that the style will be European or Americans, and initially we saw a bit of American style, but now I think it is probably 99% European style. To me, there's no different. I think you see, when you buy a warrant, there are two components to the cost: the intrinsic value and the conversion premium, or the time value premium, right? Let's say it's 8%, and that premium will slowly dwindle to zero. In which case, when it expires, you will lose 8%. Now, why would you, when it hasn't expired yet, choose to convert? If you convert, simply means that you are throwing away, maybe it's 4% or 5%. That would be not a sensible thing to do. So having this option to convert early, people may say it's good, but it's actually self-defeating to convert, unless you're talking about the company issue warrants, in which case you may have some tactical reason you want to convert. You may want to convert to participate in certain exercise, or if you are the major shareholder, you want to vote on certain issue, you convert your warrant, and then you have the right to vote. Yes, but not core warrant. Core warrant is, there's no advantage to having American style over the European style. Yeah. Back to you, Anna.
All right, thank you, Alex. And our next question, what is your opinion for newbies to trade indices structured warrant like FBM, KLCI, and HSI? And also, what is your advice on US options?
I cannot comment on US options. I'm not that familiar with that. And trading on call warrant or put warrant on indices. To be frank, I think the same approach would apply, though I very seldom entertain such requests from my customer, except for that particular case that I mentioned earlier. So I'm much more comfortable talking about call warrants on stocks, or even combination warrant on stocks. Yeah, I don't think I can do justice to that question. Yeah, back to you, Anna.
Okay. The next question is that, assuming we filter based on the 5 steps and the trading volume is low, do you still recommend to trade this warrant?
Okay, trading is we have to define what is trading a bit. Trading, some people think that I buy today, sell tomorrow, or sell next week. Trading can be medium term. You can hold it for 2 days, 2 weeks, or a month. And in that case, if you are really bullish about the stock, you are essentially positioning for the kind of time frame for it to move. Then, if the market see the potential of that, they will come in. I think that you should not be influenced by the volume traded in the stocks. Of course, there are some stocks that are actually pretty dominant in the market, and then the warrant is also fairly dominant, and the only people who can buy from you or sell to you are actually the market maker, and there's no reason to get into that because the share itself probably is not bullish. But once the shares start to move, if people don't trade, it's still all right because the intrinsic value will be going up, and you would enjoy that. And the market maker is not going to, offer to sell at lower than that intrinsic value. So you will enjoy that. Yeah. So
Okay.
back to you, Anna.
Understand. All right. The next question is asking that why is there a situation? I think it should be, will there be a situation where the share price goes up, but the warranty price goes downward?
Share price goes up, the warrant goes up.
The warranty price go downward.
Okay, that's a very interesting question. If you Google my blog, next trade V Solar, right? You will find that I have done a few posts write up on that. When you have a situation of a share price going up and the warrant actually comes down, right? It reaches a situation where it is so much more attractive to buy the warrant, convert it, because the total cost of that is actually lower than the share price. And my comment is that whenever you see something like that, let me repeat that again. If you have a situation where if you buy the warrant, you call that a mispriced warrant, and then you pay the exercise price, so your total cost is still lower than the share price. When you see a situation like that, get away. Just sell the shares if you have the shares, sell the warrant, just avoid it. Because situation like that shouldn't exist. If it ever exists at all, if I'm the major shareholder, I will sell the share and I'll buy the warrant and I'll exercise it and I get back in position 1, which is I have back the same share. Then I will make the money. I will realize a profit because the amount that I get from selling my share is more than the whole trouble of buying the warrant and exercising the warrant. And it shouldn't exist. It shouldn't actually exist. In the case of VSolar, this happened, and I point out that share and that warrant is going to drop. And sure enough, it actually did. It dropped big time. So it shouldn't happen. If you see it, it is a warning sign that play is over. Get out. All right. Yeah, Anna, back to you.
All right, very interesting. The next question, Eric is asking, can you tell us a few company warrants that are worth looking at right now for entering? Please tell us a few of your portfolio.
Actually, if you ever visited my blog, you'll find at the bottom there is one portfolio and which I had never updated. Some time ago, I thought I can set up a portfolio and help people. And that actually is one of my weaknesses. I am not very good at setting up portfolio. To be honest, Frank, I'm pretty good. I shouldn't be praising myself. I do a decent job in analyzing stocks, but I'm not good at having analyzed a stock and I say you choose A to G and you forget about the whole market. I'm not good at that. So yeah, that's one part of your questions. And if you're talking about warrant that you can look at, actually right now in this market, you have two category of stocks in the market. You have stocks that are going up and continue to go up, and this is a very small group of stocks. We're talking about, maybe the rubber glove. Yeah, they seem to be going up. And then you have another category that is going down badly, and we probably will be looking at the construction company and some politically linked company because the general elections has an effect on them. Some people say, I want to buy this cheap stock. Right? I want to buy, for example, Gamuda. Yes, by all means, you buy Gamuda. But if you're talking about buying the core warrant, it's a different story altogether. Because despite a rebound in Gamuda, some of this core warrant may only rebound very, very little because maybe it is out of the money and so on. But on the other hand, if you look at this expensive stock, super expensive stock, Hop Glove, for example, right? You look at the core warrant, they are still going. Now, if you are a trader in the market, you want this type of warrant. You know the share is expensive, but you want to trade. You want to buy the warrant and you want to sell it 2 days later or maybe this afternoon. You get into this core warrant. So just how you go about doing that, all right? You don't go about figuring out a share that's undervalued and things like that. You want to buy a share that is about to go up or is going up and is running, and you get into the core one because you want to benefit. Yeah, I hope I can answer the questions. Back to you.
Okay, very interesting. Another interesting question. I have seen many company warrant eventually go to 0.005 and the premium is high. What is the point of this company warrant if eventually it is not worth to convert to share?
What is the point of this? How to answer that? The reason why there is a so-called high premium is simply because the way premium is computed, right? Let's say the warrant is zero, okay, zero, free. You can take it, You take that warrant, you want to exercise it, all right? The exercise price is higher than the share price. That's just assuming, if you can recall, we have ABC, warrant C, the exercise price is 250. And let's say it is expiring soon and the share price is still at $2. You can recall that, right? So I give you warrant C free, zero plus exercise price $2.50. Then you divide by 2 ringgit. Sure, there's a premium, but it's nonsense. Who will going to exercise it, right? So that is the first part of the question. Your question also asks, why do people want to do that? Your question is asking, why do the company want to do that? Well, unfortunately, the company actually have a plan. They need this warrant to be exercised so that they receive some money. And that money may be for some business development or to retire some bank borrowing or bonds. Unfortunately, nobody exercises it. The project is either abandoned or the bank loan or bond would have to be settled in different way. You may do a right issue to settle it. The company, they don't like that, but what to do? Yeah, that is facts of life. Yeah, back to you, Anna.
All right. Okay, we'll take our final two questions. Okay, can you clarify further how we can enjoy the intrinsic value even though there's no liquidity to sell the warrant?
Okay, let's take a call warrant because because it's easier, as in you don't have to do anything. Let's say you buy into a call warrant, there is no liquidity. That is not possible, actually. I'll tell you why it's not possible. Because if the market maker is doing his job, he will be there. He will be offering you to buy from you, but he's not going to offer you to buy at ridiculous prices. You can actually find out the issue from the issuer, call them up. Hey, I have 100,000 XYZ call warrant B. Now, your quote is ridiculous. I want to sell. Please give me a better price. And they will put a better price there. So you can sell to him. That's one way. All right. The other way is that you can hold it to expiry. And let's say nothing changes. You will get payment because the settlement of your call warrant is actually share price minus the exercise price, the intrinsic value. You get back the intrinsic value. You won't get the conversion premium because by then it will be zero, right? So basically, that's how you get it. You get it because the final settlement price reflect that, or you can get it if you call up the market maker and ask him to give you the price, and he will give you the price. Yeah, back to you, Anna.
Okay, another question is that, do you think it is practical to trade spread in FBM KLCI index warrants just like futures, or doing hedging is much better than a spread?
I'm sorry, I can't answer that. I have a future license, but I haven't practiced that for a long time. I know what you're getting at, but I think I may answer you wrongly. So I think it's probably better that you refer to the book on that.
Okay.
Yeah, sorry.
No worries.
Back to you, Anna.
Maybe we can take another question, our last question for tonight. As we know, call option gain when price grows. Put option gain if price drop. Does this theory apply on call put warrant?
Yeah, it should. That's the whole. That's the whole game. Call warrant appreciate when the underlying asset goes up, and this is the opposite for put warrant. I mean, that's how it works. If it doesn't work that way, then there's something is very wrong. Yeah. Back to you, Anna.
All right. So that's our Q&A session for tonight. And before we finish off our session tonight, we have a little bit of announcement on waiver of clearing and trading fees. So Bursa has announced that new investors will be given a fee waiver on trading and clearing fees for 6 months, effective on 1st March. So if you are new to trading and you open an account, you'll be given this waiver fee. They are also giving waiver on stamp duty on shares of mid and small cap companies, effective 1st March for a period of 3 years. So this is to encourage people to trade on mid and small cap companies. And the next one is the waiver on stamp duty for contract notes on ETFs and structured warrants, effective 1st January, also for a period of 3 years. And this is also to encourage everyone to trade ETFs and structured warrants, which you have learned today. And the last one is GST. So as everyone knows, the GST is zero rated 1st June onwards. So hopefully this will help to encourage everyone to trade and invest. So if you want to join our next webinar, we'll be talking about oscillator masterclass. So mark down your calendar for 7 August, and I will be sending everyone the link in the chat box now. So give me a moment. So the registration link is sent to you in the chat box. You can register via the link given. And okay, so give me a minute. So I hope everyone learned something tonight and you enjoy the webinar. Thank you everyone for attending. Thank you Alex for your session. It was a great session. If you have any thing that you feel like you still want to ask, you can email Alex at this email, alexlu_kl@yahoo.com. Thank you very much again everyone for attending this webinar by Bursa Malaysia and managed by LifeChamp. Hope to see you again in the next session. Thank you and good night everyone.